Study Objective 2 is about putting a cost to that inventory that we just counted in Study Objective 1. So, on the balance sheet, inventory is listed as an asset. Dollars are listed there, not units. So we've got to be able to put a cost on the units that we've just determined that we own. So this study objective goes through those methods that we can use to put a cost on that inventory. A really basic one that really isn't used very much is specific identification. This is where you actually track the cost of every single inventory item that you buy, and then if you still have those items at the end of a period, you simply add up that cost, and that's your ending inventory. If you sell those items, then you add the cost of the ones you sold, and that's your cost of goods sold balance. So in this example, these two TVs are sold here and here. So those two amounts, $1,500 in total, would end up in cost of goods sold as an expense, and ending inventory of $750 would remain on the balance sheet as an asset. This method isn't used very much, so like I said, simply because most companies deal with too many products to track each one individually. So what we have instead is 3 cost flow assumptions: FIFO, LIFO, and average cost, that we will use to put a cost to our inventory units. I'm gonna have 3 separate videos for each one of these in a second here, but it's important to realize that these costing assumptions don't have to follow the physical flow of goods through the company's business. Like for instance, you think of a grocer and they sell milk. Grocers sell milk on a FIFO basis, first in, first out. They want their first milk that they get into their store to be the first ones that gets bought by customers, so that they don't have spoilage. That is a flow of goods, first in, first out. Now that grocer does not need to choose FIFO as their cost method. They can, but they don't have to. So it's management's decision. It's important to make that distinction right up front. And as I said before, this chapter largely deals with the periodic inventory system, and so we're going to be calculating our inventory cost using FIFO, LIFO, and average cost, assuming with the assumption that the periodic system is what's being used by companies. In these upcoming videos regarding FIFO, LIFO, average cost, they're going to use this set of data for this company, where a company has a beginning inventory of this many units, a bunch of purchases they made throughout the year of this many units, and this is what each of those purchases cost. So in total, the company has spent this much on inventory, and this $12,000 is their cost of goods available for sale during the period, and this is the total units they bought. At the end of the period, study objective 1, we talked about counting or figuring out how many units are left in ending inventory. That's assumed now to be done, and there's 450 units. That means then that 550 units must have been sold. So that's the data set that we're going to be working with in the next 3 videos.